Welcome to Trading Day. I'm Roger Peterson. Thank you very much for joining us. Let's get to some of the stories we're following in the BNN Bloomberg newsroom. The United Arab Emirates has committed to investing $70 billion in Canada. The investment will be in vital sectors including energy, artificial intelligence, logistics, and mining. The announcement comes on the heels of Prime Minister Mark Carney's visit to Abu Dhabi to strengthen bilateral trade. Carney says Ottawa is also finalizing a $1 billion project aimed at expanding Canada's critical minerals processing capacity. Consumer spending across the country slowed in September. Data from StatsCan shows retail sales fell 0.7% compared to the month prior. Sales were dragged lower by a drop in receipts at auto and parts dealers, with vehicle sales seeing their first decline in 3 months. Meanwhile, consumers spent more at food and beverage retailers. In a flash estimate, StatsCan predicts retail sales were flat in October. Shares of Dye & Durham are surging. The legal software company has confirmed an unsolicited bid from Plantro. Dye says its strategic committee has received a conditional and non-binding proposal, and it's currently under review. Bloomberg reported earlier that Plantro's bid to take Dye & Durham private is valued at $384 million and proposes to pay over double Dye's closing price on Thursday. Dye & Durham shares have dropped significantly this year, largely due to a $1.6 billion debt, but it's up 23%, almost 27% today. And taking a look at the markets right now, a little better than yesterday. You actually can see the TSX now surging after that wild day of swings yesterday over the NVIDIA earnings, concerns over the AI bubble, possible bubble. But right now, TSX composite up about 0.84%. Let's see what things are looking like south of the border. And you can see a similar situation. Everything is in the green right now. The S&P 500 up 1.16%, the Dow 1.44%, and NASDAQ an even 1%, 1.01%. Okay, U.S. equities are rebounding today after that wild week of volatility, something we haven't seen since April. And my next guest believes that this November volatility is actually healthy as it helps shake out some weaker investors, and he continues to expect a strong rally by the end of the year. Let's welcome Ryan Detrick, Chief Market Strategist at Carson Group. Ryan, thanks as always for joining us.
Thank you, Roger, for having me back. I appreciate it.
What do you like about this? It sounds like you almost like this week.
Well, I don't know. I looked on my screen. I saw this color green. It has been
Did
a
you
while
recognize
since
it?
I've seen. Yeah, well, it's like an old girlfriend. Kind of remember it, I guess. You think about it though. We just had a 38% rally on the S&P 500 in 6.5 months from let's see, it was April 8th until October 28th. And now we've had a 5 or 6% pullback, obviously mild pullback, a lot of volatility. I don't think it's overly surprising, that we're having this in November. Yes, November is usually strong. Usually it's like at the second half of November that gets better. And a couple of things you just said kind of sparked some things in my head here. The VIX, the volatility fear gauge in the U.S. here, was up over 28 yesterday. That's kind of the highest it's been in a long time. We saw record options volume also yesterday. You go back and look, and you have big spikes in option volume. You tend to be in the ballpark potentially of lows. And last comment, we're finding support right at the October lows, where the S&P 500 bottomed early October. We're finding support there bouncing. Now, we're by no means out of the woods, but I think this was just normal to shake that tree and, like you said, kind of scare some of the investors. Got a little too happy, this time, say 3 or 4 weeks ago.
Well, when things are good, it's easy, right? And when things are a little tougher, it sobers a lot of people up, doesn't it?
No, it does, and we've I think a lot of people have sobered up. I love looking at market sentiment. We've said this is this bull market in general is going on for years, right? Yet people just continue to doubt it. Sometimes you get angrier the higher it goes, and then you get some well-deserved volatility like we've just seen. And I get it. Like even yesterday, we're all still scratching our head exactly why at 11 o'clock Eastern time everything started to fall apart. Was it comments about private credit? Was it concerns about cryptocurrencies crashing, AI in a bubble? I mean, whatever it was, the reality is that was one of of the nastiest reversals we've ever seen. But when you go back in history, Roger, the most recent time we saw a day up about 1.5% at the gap open to close down was April 8th. That's the day before the S&P 500 bottom. Sample size of 1, I get it, but I think its volatility is normal. One more thing. I think listeners might like this. On average, you see a 5% correction 3.5 times a year. All right. This is just our second on the S&P 500. I think, again, this is normal. Volatility is the toll we pay to invest. We like to say that on the Carson team. And if you want to have the longer term gains a stock provides you, you have to withstand the wrong way to put it, the volatility and the kind of scary moments like we've had the last couple of weeks.
Now, and of course, everybody's been talking AI. Is it too much? Is it into bubble territory? But you have a chart that's interesting. I'm going to pull this up. Shows the top 10 holdings in each country's ETF, and the U.S. is about 40%, but nowhere near some of the market concentration in other countries. Like I'm looking at Denmark, and I think Belgium was 98%, which I'm not sure the reasoning behind that. Maybe you can explain where they're sitting, and even Canada's higher than the U.S.
Yeah, well, the easiest answer is the U.S. has a lot more stocks, right? So if you have one that has, 98%, for instance, it's probably only a handful, like Taiwan Semiconductor. That does equate for a lot, obviously, in Taiwan. But the reality is all we keep hearing is how these 7 stocks are so much of the market, or like we just said there, the 10 largest are 40%. If you look exactly 12 months ago, the 10 largest stocks in the S&P 500 were 40%. Go back a year before that, they were ballpark 40%. So, I just don't agree with all this talk about the market being top heavy. Only so many sectors are going up. Only so much participation. This time a week ago, the ACWI ex-US all world index, so everything else ex the US, literally closed at a weekly all-time high. All right. Mm-hmm. I mean, I don't buy this argument that this is a top heavy market. That only a few stocks are going up. It's not true. I think it's the best way to put it. And that shows again, the U.S. isn't as top heavy as you might think. There's a lot of countries that are way more top heavy. And if U.S. top heavy, then everybody's top heavy. And maybe that's another argument for a bear, but I don't buy it.
Okay, you're seeing bullish for at least to the end of the year. Any headwinds that could derail that?
Well, there sure are. I mean, it feels like every day we come in, at least from the U.S. point of view, we get a different Fed member give some comments. There was Williams this morning that said, yeah, maybe a rate cut's back on the table. And now we're all like, oh, maybe there's a cut going to be in December. The reality is that the Fed is kind of that thing that's out there. I don't know if they really have to cut in December. I think the economy is still strong. We've just had a really strong earnings season. There are some things to think about. One more thing, when you're up at least 10% for the year going into November, like we were on the S&P this year, the last 2 months of the year, that's November, December, have been higher the last 16 times in a row. I mean, call me glass half full. I still think this is going to be 17. I think this is washout we had is going to lead to Santa Claus coming to town, and still an optimistic view on equities the rest of this year here.
Now, what kind of a factor, though, could we see consumer confidence in looking at some of the numbers? Second lowest level ever. And retailers coming with their profit guidances, some of them adjusting. What kind of a factor could that be?
Yeah, it can be a factor, but I will say this. You go back in history and just look at consumer confidence levels. When they're low, that's when you actually want to be buying, right? When everybody's optimistic and happy, that's usually when the market maybe is closer to a peak. But it is still fascinating to us how the consumer says they feel one way, but then you look at retail sales data, which I know we haven't had it in a while because U.S. government was shut down for a while there, but we're still seeing consumption. We're still seeing spending out there. Of course, when you look at earnings season, you can find a company or two or multiple. I know the fast casuals they blame the millennials, they blame Gen Y because they weren't buying the burritos like they used to. I don't know on that front, maybe because their prices are way too high and people just don't want to do it anymore. But the reality is people are still spending and doing things. It'll be nice we get the government data to confirm that. One more thing on this. The labor market, it's kind of weakening, but we got some initial jobless claims just yesterday, 220,000. I know continuing claims continues to tick higher. So it's not a perfect scenario, but I think the potential cracks in that labor market, Roger, are why the Fed should be cutting. We're not worried about inflation here. There are pockets of inflation, yes, but shelter is coming back, rents are coming back, used car prices last 3 months are down. There are some things that say there's a lid on inflation, and cutting makes more sense to us going forward from a Fed policy.
Okay, we're going to have to leave it there, Ryan, but thanks as always for joining us.
Have a happy weekend. Thank you. Appreciate it.
And you too. Ryan Detrick is Chief Market Strategist at the Carson Group. Coming up next, Jenna Lyons, designer and partner at Fundamental Co. and former president of J. Crew, sat down with Bloomberg TV to discuss her mission to rebrand private equity. You want to stick around for that. Jenna Lyons, designer and partner at Fundamental Co. and former president of J. Crew, and Johnny Bauer, Blackstone's former global head of brand strategy and transformation, joined Romaine Bostick and Katie Greifeld on the close to discuss their mission to rebrand private equity. Their goal is to bring brand thinking much further upstream in the value creation process and ask what a company could become next, aligning investors and management around that vision. Take a listen.
It's been exciting. We started with this idea, and it's really a new idea. We're taking this idea of value creation, but really putting brand at the center. And I think when you look at the traditional marketing, it often gets segmented separately from strategy. And what we've really done is trying to join those two things. And I think my experience with Mickey and really understanding how brand needs to permeate every level of what you do, it's what people remember. It's the touch points. It's what's the center of gravity of your company. And that's just as important, but sometimes it gets relegated into a logo or a marketing campaign. So in the past 2 years, we've really made an effort to bring those two things together and also to share with PE firms who may not be as used to this kind of conversation how important and central it is to the business we do. And so, we're 2 years in and we're growing. We've just hired Alex Lubar. We have a new CEO, and it's exciting. So Johnny's now not in the day-to-day, which I think is good for him, and it's allowed us to really step up and focus on the next phase.
So, Johnny, I am intrigued by some of the work you're doing with some of these private equity firms. We've talked a lot on this program about sort of the capture we've seen with a lot of the sponsored companies, the idea that they're staying private for longer, they're not able to go public, some don't want to go public, but it also means these PE firms, they're not just investors anymore, they are real managers of these companies. What does a branding experience look like when you're working with financial engineers who maybe aren't necessarily well-versed in branding?
Well, firstly, I want to say that I'm very much still in the day-to-day. I'm just taking on a slightly different area of focus. But to answer the question, what we do, regardless of where a company is in its investment cycle, whether they've just been acquired or whether they're getting ready to sell, we help orient the company with the around a set of ideas that define what is the company's next chapter, and is the company transforming into its most valuable potential form. So when a company is acquired, what had typically happened in this PE-backed context is they'd buy a company, then there'd be a lot of interventions, and then they'd bring the brand people at the end to say, who are we? And why we exist is to really bring that brand thinking much further upstream in the sequence of value creation and ask the question, what could this company become next? And then tether all of the interventions to that set of ideas that create real alignment between the investors and the management teams. And we started the practice with inside Blackstone. They were the earliest adopters. And we spun ourselves out into an independent company 2 years ago. And what's exciting is that we've proved the theory out beyond Blackstone to some other big sponsors like Towerbrook and Thrive and Apollo and Bain Capital. And we're doing this work for a bunch of their portfolio companies too, as well as now some public companies are approaching us and asking, can you apply some of the learnings that you've had at the private markets to the public markets with a view to enterprise value?
Well, Johnny, that's what I was curious about, how you build up this roster of clients that you work with. I'm sure a lot of it is repeat business, but, are you going out and establishing those relationships, pitching, if you will, or are you at the point where, folks are coming to you?
Well, it's a little bit of both. Our business has grown 100% on referrals. And we are growing through doing more work for more portfolio companies within a pretty small group of sponsors, but they're all giving us more works and more assignments, and we are starting to now have the bandwidth to take on more sponsors and different PE firms.
And Jenny, you made the point that, a brand needs to permeate everything when it comes to a business. It's not just a logo. And I wonder, how often you see just plain missteps. I'm thinking about Cracker Barrel, of course. What a difficult summer they had. But I'm sure that, that's the exact type of situation you want to avoid.
I agree. And I think what's interesting is that that's where people get caught up. And they caught up in the idea that it's a visual, that it's a marketing play, as opposed to like a set of ideas that everything gets organized around. So who do you want to be? What do you want to say? What do you want the public to know about you? What's important? What is your mission? And then everything you do has to go back to that mission. So if it's really important to you to sell the best cheese in the world, then let's make every single decision around that. And oftentimes what happens is it gets separated to the marketing area, which it's really about the strategy that happens way upstream. And I think you asked the question about how do you get people in that world who don't really understand it?
Yeah.
When you lead it back to value, how does this add value? How does this create value? How does it continue to help you grow your value? It helps, I think, that team really understand the mission and what the advantages are.
I am curious, though. I mean, doing it further upstream obviously makes a lot of sense. Yeah. But what about sort of legacy brands that maybe have lost their way? I mean, we talk about the resurgence of J.Crew and Gap, Macy's, all these great brands that have lost a certain sort of cachet and identity. Can you get that back without having to completely rebrand?
I mean, it's a great question, and I think you can. I think the biggest challenge is in those moments, there's a lot of people that have been there for a very long time. So how do you galvanize them and get them organized around an idea? Because over time, there's like a creep. Everyone has a slightly different version of what they think that brand has become, and it's very hard. So I think oftentimes legacy brands are it's the most valuable because they need a moment to regroup, retrench, and say, what do we really care about? What do we want to be? What do we want to say? And how do we want to say it? And what are we doing from the very inception? What is our strategy, not just for tomorrow, but for 5 years? How are we going to get there? And getting everyone in a room to really agree on that and understand it in a similar way. It takes a lot of experience, and I think having had the experience, I've done it at J.Crew and Madewell Mickey too, you start to realize like bringing everyone in is just as it's not about just the CEO. While the CEO is important, it's really about bringing the entire team together to say like, your piece of the pie is just as valuable. You're in accounts payable. I want you to know what our mission is. You're actually in marketing. Of course you have to know, but every single person in the company needs to feel connected to the trajectory and what we're about.
That was Jenna Lyons and Johnny Bauer on Bloomberg's The Close. Hollywood could be going through a major shakeup with Netflix, Comcast, and Paramount Skydance all submitting bids for Warner Brothers Discovery. I'll have more after this. Netflix, Comcast, Paramount Skydance, all submitting bids for Warner Brothers Discovery. This, according to people with knowledge of the matter, setting the stage for one of Hollywood's biggest companies to be sold, maybe even broken up. For more, we're joined by Bloomberg Intelligence's Geeta Ranganathan. Geeta, thank you very much for joining us today.
Thank you so much, Roger, for having me.
Quite the news from Hollywood. What are some of the possibilities we could see unfold here?
Yeah, so as you know, Roger, Warner Brothers Discovery, which is a conglomerate really of so many different assets. So they have the TV networks business, but they also have, the iconic Hollywood studio, as well as a streaming unit with HBO and HBO Max. And so they've basically outlined a path where they have put themselves up for sale, either the entire company or the different parts of the business, failing which actually they will anyway go ahead and split the company. So you have the two different parts. One is the TV networks business, which is kind of a no-growth business, but the streaming and studio assets, which is what everybody is after, is the one which is actually promising high growth, and they're kind of trying to do this to unlock value. So they have two plans here in motion. One is, of course, the plan to sell the company, and the other is the plan to split the company.
And I guess who's offering what when they in the opportunity to buy it or buy? Does somebody want the whole thing, or does everybody want a little bit of something?
Yeah, exactly. So Paramount Skydance, and by the way, Paramount Skydance was just a recently formed entity. It came together with the merger of, Skydance from David Ellison, who bought Paramount. That actually just happened in August, and they've really gotten to work pretty quickly. And they have come out with a really bold move to buy all of Warner Brothers Discovery. So it's not just the studio and the streaming assets, which is basically, the crown jewels, but they also want the TV networks. And the reason they want the TV networks is because Paramount Skydance itself has fairly substantial exposure to TV networks. And the idea here is, even though it is kind of this melting ice cube business, putting them together and getting scale does allow you to get a lot of synergies, extract a lot of synergies, and really generate a lot of cash flow. And so that's the idea for Paramount Skydance. For Netflix, of course, they are a pure play streamer, so there's absolutely no interest in the TV networks. So they are only interested in the studio and the streaming platform, which is HBO, and same goes for Comcast.
And I was just looking at the story. Netflix apparently saying that it would give up its longstanding opposition to releasing films in theaters as part of what they want.
Yeah, that is a little bit of a head scratcher. I mean, we've known that they've always been such a loud voice and so vehement, when it's come to theatrical releases. So this obviously is, I think, just a way for them to kind of placate the regulators, placate, Hollywood top talent and attract them. And who knows, maybe they're kind of rethinking a whole reshuffle of the business model itself. Yes, streaming is their main bread and butter, but maybe, allowing for some theatrical releases does open up a new revenue stream for them, and maybe a good way for them to get more, exposure in Hollywood as well.
Okay, and is there a front runner, and when will we know if and when any of these might come together? We're almost out of time here, too.
Yeah. The front runner, I would say, is Paramount Skydance. And I say that because, one is they won the whole company, but I think the bigger reason is because they really have the whole Trump machine kind of backing them. So regulatory should be pretty easy for them to navigate. And as far as when everything pans out, it's going to be a long process. So these were just first round bids. Expect a lot more rounds to come in the coming few weeks.
Okay. Geeta, thanks very much for joining us with this.
Absolutely.
Bloomberg Intelligence's Geeta Ranganathan. And we've got lots more coming up on the show, including today's top headlines from the BNN Bloomberg newsroom. Stay with us. United Arab Emirates has committed to investing $70 billion in Canada. The investment will be in vital sectors, including energy, artificial intelligence, logistics, and mining. The commitment comes on the heels of Prime Minister Mark Carney's visit with UAE officials in Abu Dhabi in an effort to strengthen relationships. Dye and Durham shares are seeing a spike after it confirmed an unsolicited bid from Plantro. It's up nearly 20% right now. The legal software company says its strategic committee is currently reviewing the proposal. Bloomberg reported earlier that Plantro's takeover bid is valued at $384 million. Dye and Durham is currently facing a $1.6 billion debt, as well as a potential default due to late financial disclosures. Shares of Ross stores are rallying, up 7.33 right now. The discount retailer posted profit and revenue in its latest quarter that exceeded estimates and saw a spike in same-store sales. Ross also boosted its full-year profit forecast by more than expected. Analysts are also highlighting strength in its women's fashion brands as a positive going into the holiday season. And taking a look at the markets now, a little bit of a bounce back from yesterday's rough ride that saw some of the biggest intraday swings since April, and actually on record too. TSX right now up 0.63%. South of the border, also everybody in the green right now. S&P 500 up 0.92, Dow up by 1.17, and the Nasdaq up by 0.69. Stats Canada released October's housing price index. Looking at the pricing of new housing, September saw a decrease of 0.2% across Canada compared to August. In September, Ontario saw the largest drop, 0.5%, while Quebec saw the largest jump, 1.1%. The CMHC also released October housing starts, reporting an annual drop of 17%. To help break down some of these numbers, let's bring in CTV's Kamal Karamali with some more on them. Kamal, thanks as always for joining us. How do these numbers stack up? Previous month, previous year? We'll stop there.
Okay, you mentioned, Roger, 0.2% drop the previous month. Well, month over month now, looking at October, it has dropped another 0.4%. So 0.6 total drop in the housing price index, new housing price index in the last two reports. And looking at the year over year number, it has dropped 1.8%. I believe we have those numbers to show you. And so what that says is for buyers and prospective buyers, this might be a good time to try and enter the market. It is benefiting those who might be looking to buy a new home, seeing that these numbers and the prices are continuously dipping month over month as well. It was expected to be unchanged for this latest report released by Statistics Canada, but once again, now seeing a 0.4 4% drop and a 1.8% drop in new housing prices year over year. Most provinces seeing a drop this month as well, if you break it down province by province, with Ontario seeing a 0.6% drop and Manitoba seeing a 0.7% drop. I mentioned that this is a big benefit for buyers who might be looking to enter the market as these prices continue to drop. For sellers, not so good news, as they might be losing money. And what is causing new housing prices to drop? Well, it indicates a slower market, obviously, but also we're seeing that and hearing from housing experts that it really has to do partially with the increase in housing supply. A lot more homes have been built, and the demand seems to be slowing down as well. Those trade tensions and tariffs also playing a role. So it's an amalgamation of factors here, Roger, that are once again seeing a decrease, a 0.4% decrease this month, or rather in October compared to September.
All right, let's just jump here and talk about the September retail sales numbers that came out, down 0.7% to $69.8 billion. How did it look? How did the different subsectors shape up?
Yeah, so 0.7%, as you mentioned, across the 9 sectors across Canada. And that is down to $69.8 billion in spending in September across the country. But year over year, it's sort of bittersweet because you saw a 0.7% drop in September compared to August. But year over year, comparing it to last September, seeing an increase of 3.4% in retail spending. And so, but the biggest drop and the biggest focal point that a lot of people are looking at is the motor vehicle and parts sector, down in September compared to August by 2.9%. So car dealers, and specifically new car dealers, seeing a drop in sales this month, 3.6% in September compared to August. I do believe we have a clip as well as to, well, we don't have that clip, but experts are saying that a lot of that has to do with, look, the demand increased after the pandemic once manufacturing ramped up again. So a lot more people were buying cars directly after the pandemic, after that backlog ended. And then now it's sort of evening it out and dipping down.
Okay, Kamal, thank you for that.
You're welcome.
CTV's Kamal Karamali. Well, Gap Inc. president and CEO Richard Dickson told Bloomberg's Lisa Abramovich that the company's third quarter tariff impact was in line with their expectations. They actually exceeded their gross margin outlook. He says all of their recent collaborations are geared to different audiences to help drive brand relevance across the consumer base. Take a listen.
We've had consistent strength from our consumer behavior that we're winning, actually, with all income cohorts. When you look at the overall sales, comp up 5%. That's the 7th consecutive quarter of positive comps for us. Our leading brand, Old Navy, the largest brand, delivered an outstanding quarter. We were up 6%. Gap up 7%. Banana Republic up 4%. Gross margin exceeding expectations. So from an overall perspective, what we see and are proving is consistency in the context of our strategy and our playbook. As we look at consumers, we do see the consistency and strength with our customer behavior. And we've been winning with all income cohorts, as you could see from the differentiation in our portfolio. We saw equal growth across low, middle, and high. And while we're seeing, external data points to macro pressure, particularly on the lower income consumer, our customers are finding our price, our value, our style breaking through the competition. And ultimately, we're very excited to be winning in the marketplace, giving us a lot of confidence as we head into the holiday season.
Yeah, talking about the holiday season, how robust do you expect it to be? How is it coming along? And how much are consumers resilient, even in the face of price increases?
Look, holidays come every year. We're off to a great start. We have great activations that are planned this holiday. In particular, I'm very excited about certain categories: denim, sleepwear, fleece. These look really strong. Our value proposition, our marketing executions. Hopefully, you've seen some of the creative. When you go online to our sites, we're well positioned to serve our customers wherever and however they choose to shop. We just, for example, Old Navy did a partnership with DoorDash, which provides convenience for tens of millions of users. Our stores are ready, our teams are fired up, and we're looking to a strong finish to the year.
So, Richard, I expect you actually coming on and dancing to Milkshake in the background, because I hear you talking about some of the cultural relevance, and I wonder how much the battle for cultural relevance has been front and center for you about that viral ad. How much are you looking to new partnerships, new types of advertising as a way to really drive Gap strategy?
Cultural relevance is a very important part of our playbook, and we talk about relevance with revenue. You can have relevance but not revenue, and so the key to success is when you have relevance that drives revenue. And collaborations do help brand relevance. Now, it has to be the right collaboration and a win-win methodology, but it does do a really good job broadening its consumer base when it's done well, and continue the drumbeat between bigger and larger releases. So to stay in the cultural conversation, Gap brand has launched over 13 collaborations that continue to just drive excitement and surprise. But what I will say is that these are very precise, and as I said, need to be win-win and authentic to the customer. They do attract different audiences, and in the Cat's Eye case, we did an extraordinary job continuing to introduce and discover Gap to Gen Z, which has been a really exciting segment for us. We got 8 billion impressions, 500 million views for the Better in Denim campaign. It was literally a global takeover, and it's become one of the brand's most successful campaigns to date.
Yeah.
We drove incredible traffic and, of course, double-digit growth in denim.
I have to ask, Richard, was this a direct response to American Eagle's Sydney Sweeney ad?
Look, I think the fashion industry is proving creativity, and competitively, we love the fact that there's lots of different conversations around fashion and particularly denim. We are front and center with our strategies. We did a Better in Denim campaign that was specific to Gap, expressing our originality and to some extent, sometimes it's convenience and sometimes it's ironic. But I think in the context of the denim dialogue, we certainly had our fair share of goodwill. The
denim wars continue, Richard. We just have just about a minute left. I am curious, going forward, how much you are seeing sort of that tariff-related impact on pricing, how much has already been factored in, and how much going forward you expect to still have to pass through?
Well, I would first call out our team. We have done a great job with our mitigation plans, which we've shared many times. It's been focused and thoughtful, making adjustments to sourcing, manufacturing, our assortments, and many other actions. And all of those actions were designed for the reaction of our consumer to continue to have our value, quality, and style portrayed, which is most important. The third quarter tariff impact was 190 basis points, but that was in line with our expectations. And despite this, we actually exceeded our gross margin outlook, which was driven by top-line momentum, less discounting, better regular price sell-through. So we're going to continue to pursue our mitigation plans, but we remain focused, most importantly, style, quality, and value for our consumer.
Gap Inc. President and CEO Richard Dixon was speaking with Bloomberg's Lisa Abramovich. Coming up, Hot Picks. We'll zero in on 3 plays in the gaming and leisure sector. Stay with us. Time now for some hot picks. We zeroed in on 3 plays in the gaming and leisure sector and sat down with James Hardiman, Senior Vice President and Leisure Analyst at Citi. And we kick things off with Wynn, his top pick. They are a leading developer of luxury casino resorts.
The real thought behind Wynn is that they are, a premium operator of premium properties that target premium customers. And so much of what can explain what we've seen in our sort of consumer discretionary coverage in recent years has been the idea of this K-shaped economy, right? Mm-hmm. And I get the question from investors all the time, what are the best equipped companies to navigate such a divergence between the high end and the low end? And I think Wynn is at the forefront of their ability to do that. As we think about the Las Vegas Strip, right, which is where they have one of their main properties. It was a rough summer on the Strip, but it was primarily those sort of middle income, value oriented properties that really struggled over the summer, whereas Wynn's properties did quite well. And so they've got exposure to a recovering Vegas, but they're also in pretty good shape as we sit here today. And then as I think about their Macau business, Macau, China, where they have a couple of properties, that's actually a market that's outperformed expectations this year. And there's some real opportunities for Wynn to gain share there in the months to come. And then I guess lastly,
No, sorry, go ahead. No, go ahead. Go ahead. I'll jump in
the
after.
last point I was going to make, there's some idiosyncratic. So as you'll see with all these top picks, like these are companies that have exposures to trends that we think are favorable, or a lack of exposure to trends that we see are being unfavorable. But then in addition to that, there are some idiosyncratic factors, right? Company-specific factors. And for Wynn, that's the fact that they're going to be opening the first casino in the Middle East, right? They're going to be opening what's called Wynn Al Marjan in the UAE in 2027, and that's a big opportunity for them.
I was just looking with the China, you mentioned Macau, and they even have a wine award. Like, so they're looking at different opportunities, right?
That's right. That's right. As you think about that premium customer and what they care about and what's going to move the needle for them, I think for decades, Wynn has had their hand on the pulse of that customer, and that is really paying dividends in the current environment.
Now, any concerns about it being hit by any potential downturn with the markets?
Yeah, look, I mean, they are at the end of the day a consumer company, and so if we see sort of broader recession, I think everything that I cover, which again is consumer discretionary, in a lot of cases, big ticket consumer discretionary is going to get hit. But as you think about sort of what my job is, and a lot of my counterparts' jobs are, is it's picking relative winners and losers. Okay. And so as we think about their particular exposures, right, the customers that they're targeting in, that's a customer that's going to outperform.
All right, I want to get the other two in that you want to talk about. Carnival as well. It looks like the cruise lines are back.
Yeah, I've been back and better than ever. And who would have guessed that a handful of years ago when we were coming out of COVID, and it felt like COVID was the really existential threat to the cruise industry, because so many people
Absolutely.
that I talked to, they were already, I think, weary of going on a cruise. You're hearing, I would never go on one of those things. And it is cruise consideration today is actually 50% higher than it was in 2019. Take a moment to take that in.
Yeah.
You were looking at 6 in 10 Americans that would consider taking a cruise in 2019, and that's more like 9 in 10 today. Now, the actual penetration is way less than that, and therein lies the opportunity, right? That people are considering it. Getting them across the finish line is certainly a big opportunity. And Carnival, again, they've got exposure to a cruise industry that we think has a lot of secular tailwinds. But then in addition to that, they've got some company-specific initiatives. Most notably, they just opened their own private island destination called Celebration Key. 2026 will be a year, and the first full year that they're going to have that island open, which brings with it a whole lot of benefits as you think about consumers' interest in going on their particular cruises and going to their particular destinations. So really compelling story there as well.
So I'm curious, that from 6 in 10 to 9 in 10, is it that saying there's no such thing as bad publicity? The pandemic scared everybody about it, but it also raised awareness of it.
No, I mean, I think that was definitely bad. The concern that you were going to get stuck on a cruise ship and or catch some communicable disease. I would make that small exception for that press being bad press. No, I think the cruise industry has gotten better in terms of the product that it delivers. Part of that is these incremental offerings, these land-based islands, most notably Royal Caribbean opened what's called Perfect Day at Coco Cay, which has been an absolute home run. All of these things have happened at a time when I think traditional vacations, land-based vacations, have arguably gotten worse, right? They're more expensive, right? Hotels are more expensive, and in a lot of cases, service levels have gone down because as these hotels have had to deal with higher labor costs, they've cut back on staff and service.
Right. I'm going to jump in because I just want to get in the last one, BRP. Sorry, we've been talking a little too much. My apologies. Canadian manufacturers, snowmobiles, off-road vehicles, boats, one of my faves. What do you like about it?
Yeah. Great company, great management team. Although the longtime CEO is stepping down, and they're in the midst of a CEO search. It's a segment that seems like it's gaining steam really over the summer, right? Off-road vehicles. But then it's a company that we think if there's going to be a share gainer in this space over time, it's going to be them, right? Great sort of engineering-based company that makes great products that we think will ultimately be a share winner.
And that was James Hardiman, Senior Vice President and Leisure Analyst at Citi. Still ahead, Bloomberg's Christine Dodd. It is Friday, and that means we are being joined by Christine Dobby, Bloomberg's Canadian banks reporter. Christine, thanks as always for joining us. And you opened the Bay Street Edition newsletter with "The penny is dead. Long live the stablecoin," which I think is going to go down in history as one of the greatest lines and quotes ever. We'll be quoting that regularly now. Let's start with it.
Yes.
Stablecoins. I think a lot of people, they're just getting used to crypto. They hear Bitcoin, and now stablecoins making its way in. Let's first start off, what exactly is it, and why should people be interested in it or aware of it?
Yeah, and this is something that a lot of people still don't really know much about. I remember just this summer I was asking one of my colleagues to explain this to me at a bar. So stable coins are a type of, right, the normal bar talk, right? So stablecoins are a type of digital currency that is backed one-to-one by government-issued fiat, or something like the U.S. dollar. So they do trade on blockchains, but unlike crypto, they're meant to be very stable. That's in the name. And to achieve this, issuers of stablecoin hold one-to-one essentially value, they hold very non-volatile securities such as government bonds on a one-to-one basis against the stable coins. And what I was talking to my colleague about in the summer was sort of, why would I need this? I have no problem paying for things as it is. One of the huge advantages of stablecoin, because they travel in the blockchain, is that they can be traded instantaneously, and they can be traded for a very low price. So when you think about things like international money transfers, so about 1/5 of Canadians send international remittances on a regular basis, and they're charged pretty high fees for that. Stablecoin can play a huge role there. Another place that stablecoins can be used is in the payments that retailers accept. For small businesses, the 2 to 3% processing fees for Visa and debit cards can really be quite expensive, a huge expense for them. So those are some of the potential use cases for stablecoin, and it is a growing market. One Bloomberg intelligence estimate suggests that by 2030, about a quarter of consumer payments will be done using stablecoin. That's $55 trillion. So it's something that I think we all kind of have to start getting our heads around.
Well, it does make it more functional. I mean, Bitcoin, I think, has dropped how much? 25% in the last 2 weeks, or some. It's dropped a lot, and you wanted to be able to come in. There we go. Take a look. What do we see it drop? Look at it in just a couple of weeks. It's off $15,000, and that people don't have the stomach for that. And if you want to use it as a currency, it doesn't make a lot of sense. So, are we regulating it up here? The U.S. just passed the Genius Act. Are we doing something similar, or are we behind the 8 ball here?
Yeah, so that's what I wrote about this week, was that Canada has actually introduced a stablecoin framework as part of the Budget Act that was put forth this week. A lot of people in Canada said we were behind on this, but the government has, since the U.S. passed that Genius Act, has acted pretty quickly, and it looks like we're moving towards some legislation in Canada in the near future. And
it sounds like it's something that's needed. We're out of time, but thank you very much, Christine, for joining us today. We appreciate it.
Yeah.
We'll see you at the bar. Bloomberg's Canadian banks reporter, Christine Dobby. And that wraps up this edition of Trading Day. Have yourself a great weekend. I'm Roger Peterson. Thanks for watching.